Hey, Becky, yeah, the Fed is supposed to be listening to the data, be data dependent, but it's sounding a little tone deaf these days. Wage growth, as you said, slowed. Inflation is down, but Fed rhetoric remains as hawkish as ever, focused almost solely on the inflation risk, not the economic risk. Bostic said, Atlanta Fed President Raphael Bostic telling us there's more work to do. Esther George on Wednesday told us that the 5% rate should go well into 2024. Tom Barkin on Friday said the inflation fight isn't over. And the minutes on Wednesday told us that no official is expecting cuts in 2023. Meanwhile, the ISM service sector contracted. December wage growth slowed. November was revised down sharply. That was the one everybody was scared about. 5-month annualized inflation is running around 2.5%. To be sure, the unemployment rate did fall by 0.2, but here's how the market reacted to all that data on Friday. The 2-year fell in 2 steps from the jobs number and then again ISM services, a sign that it sees both the inflation and the economic weakness that's out there. You couldn't see that kind of drop in the Fed rhetoric anyway. The appearance, at least by looking at the comments, is that Fed officials are not really data dependent. Instead, it looks like they've got this idea in their head to go to 5% or higher almost no matter what. Charles Calamaris, a former Columbia professor, talked to him over the weekend. He said, what's strange at this moment when things are so ambiguous is for the Fed to be acting like their actions are so predictable. The Fed may have it right. Inflation is a persistent threat, and there's been no progress to warrant a backing off. That may be correct. Or they may be making a mistake similar to the one they made last year when nearly all decided, wrongly of course, that inflation was transitory. Rather than a debate and different takes on the data, they all sound like they're talking or singing from a script that is ignoring the data. Becky?
Steve, how much of that is because of just their concern that the market is going to be off to the races if they at all indicate that they're backing down? I mean, that's what I kind of took away from the FOMC minutes last week when they released it, that is a topic of conversation, something that comes up in the room.
I guess you could call it, it's all RYCC, rhetorical yield curve control, or as Chuck Calamaris said to me, cheap talk.